Hey traders, Cousin Vinny coming to you from theclosingprint.com. This is a quick video covering a question I get most often during the trading day. The question is, where do you take stops? And additionally, how do we determine a setup is valid? Okay, so let's take an example. On September 18th, we posted a number of charts on our blog, theclosingprint.com, and we looked at Vertex Pharmaceuticals, which you can see here was breaking out of an area right at the 95 level, and we saw this as a potential candidate for a swing. We saw Bollinger Bands very narrow. RSI was traveling higher, which we noted here. We saw MACD and stochastics leading MACD. We anticipated that we might see a turn because prices were pushing above this Kirby level here. So that was the 18th that we posted this. Let's go to the Pocket Pivot scan that evening. We keep these for about a week just so we can go back to them, and we see Vertex Pharmaceuticals here. Now this is where this was the candle that we were looking at on the 18th. The next day we took a trade after the opening range. You can see where we dipped down and we moved higher. We got in right at around $97 per share. We haven't changed this dashed line, which was the original location of that Kirby bar. Okay, but because more volume piled in here and above, that level changed. So before we take the trade, we consider the depth of these candles. We consider the ATR, which in the case of Vertex is $3.35. So we take that in consideration when we place our stops. In addition to that, we look at the depth of the candle. We never want to give back more than 50% of a move. So in the case of this candle here, we would only take a move back into this candle that didn't exceed 50% before we would take our stop. We wouldn't wait until we got down below this candle. But on smaller candles like these here, we would consider the ATR. In addition, if we did place a stop, it would be down below each of these candles minus about 5 to 10%. And we would place our stop accordingly. So to summarize, look at each candle, consider your ATR, as well as a 5 to 10% rule below the previous trading day low, and then let your stop trail the move, and then we let our trade run. Now on the same day we looked at Whitewave Foods, which I know a couple of you took this trade. Now on the 18th we were right in this area right here. We were looking for a breakout, so your stop should have been on this candle right here, right around $37 per share. Okay, so you would have missed all of this pain right here. Now we're seeing buyers down here, so you may be okay on this trade, but I don't like to trade where I'm looking for a reason to stay in a trade. When you have a move in the opposite direction like we saw last week, you take the stop after this day and you move on to the next trade. Now let's talk about targets. On the 5th of September, it was late in the evening, I got a direct message from a couple of followers talking about Nike. This was the Nike chart at the time. We saw a nice pattern. We saw a nice volume with only a few down days. So what we were looking at here on this trade was stochastics was already leading. We had MACD starting to turn, and we had RSI turning up on this breakout. So what we did was project some Fibonacci extensions. We saw the 1618 was approximately $10 per share higher than this breakout. In addition, we saw this pattern. You take the depth of the pattern, which is about $10 here in this case as well, maybe a little bit less, and you project that on top of this, and you arrive at around $90 per share. So on Friday we had a nice breakout on Nike, and we hit our target, $90 per share. Now let's look at a recent trade. We'll go to our top 25 movers and shakers. We had EPAM on our list. Okay, there you go. Now the setup on EPAM, we had this one buy area on this lower trend line on higher volume as well as expanding Bollinger Bands. Prices did come back down. You would have gotten stopped out here, but we had a bounce on that particular day. We saw a volume at the 10-period moving average, which crossed over to the upside. We had Bollinger Bands was still pretty narrow, and we had a breakout and a retest of this upper trend line, which is a safer entry area for someone who's looking for a wedge breakout and a retest. So this pullback to breakout was a good buy area, and now we see prices continuing to move higher. We broke higher on Friday. We are anticipating continued upside, and we won't get stopped out until we take out the low of the previous trading day. Targets here would be the depth of the pattern, and that's about $5. So on the breakout here at 39, we're looking at $44 for our first target, which just coincidentally happens to line up with this Kirby bar, or a volume by price bar. So we're looking for at least $44 per share to take profits. Now, in the case of EPAM, this was a scalp for me on Friday. You can see on my stream right here that I posted late in the evening after the close that EPAM was a scalp. All right, we'll be looking to get back in on Monday if we have a retrace, maybe 20 to 30% into Friday's candle. Now, that's an important point because I wouldn't want to give back all of this profit right here. So in the case of a larger candle, like we saw on Vertex Pharmaceuticals and again here on EPAM, typically if a trade moves back into a candle by more than 50%, I take the stop. The other thing we look at is the ATR on each stock when we're determining weakness or strength. In the case of EPAM, the ATR has started to turn up, but it is at $1.09. So half of this candle would be about 75 to 80 cents. So that would be my stop. If we took out more than the ATR of the stock at its current price. So to summarize, we like tight Bollinger Bands. We like a nice pattern. We watch what our Kirby bars are doing. In this case with EPAM, we had a Kirby bar right here, or volume by price bar. That prices broke out of a wedge, came back down, retested a level, and then stochastics turned again right here and gave us an opportunity to get back in a trade. We saw these two volume by price bars here and here. Now we project our target using the middle of this wedge and setting it on top of this wedge breakout area, which gives us a target around $44 per share. Now, if this continues to move higher, we won't be able to trade this, but if you're in it, you would move your stop up to the next trading day low, minus maybe 5 to 10%, depending on what your risk is. So if this breaks higher and hits 44, I would take some off because we have come almost $5 original target, and you want to protect some of your profits, so I would trim and trail in the case of EPAM. In the case of Vertex Pharmaceuticals, we had a very similar situation. We had a breakout of a descending trend line. We took it the next day. We continue to move our stops up under the previous trading day low. So on Monday, we had a low down here below $102 a share. Continued to move that up on Wednesday. On this Wednesday candle, we wouldn't have let this whole candle profits get taken away, so we'd have been about 50% into this candle down here about 107 per share. But we didn't get stopped out because we didn't take out that 50% level right here on Thursday. So we continue to swing this trade. And if you were still with us on Friday, you should have trimmed and trailed somewhere along here and be trailing a position on Vertex Pharmaceuticals. Okay, so I hope this helps explain something that I get a lot of questions on every trading day with regard to our setups. How do we project targets? How do we set our stops? And should you take a stop or should you average down? We never average down on a trade. We always take the move lower to indicate that our assumptions were wrong and move on to the next trade.